All right, Robert, we're pushing the event live to the virtual platform. Just look at this as a 5-minute heads up, and I'll be back with you shortly.
All right, I'm ready. I'm sorry, I just changed the slide.
Yep, no problem at all. And welcome to all those logging on to Money Show's virtual event, Investing in Alternatives. Thank you so much for being here today. We do have about 4 minutes before the start of the next session, so sit back. We'll be back with you momentarily. If you do have any questions, just look at that chat box in the virtual platform and type any questions that you have. Time permitting, we'll try to get those answered for you. But thank you so much for being here. Sit back. We'll be right back. All right, Robert, we're about a minute out here. Momentarily, I'll lead us off with a quick intro and we'll be all set to go.
Thank you.
All right, everyone, welcome. Thanks for joining us today at Money Show's virtual event, Investing in Alternatives. We are pleased to welcome Robert Greene, CPA, CEO of GreenTraderTax.com. Robert managed a tax and accounting firm catering to traders. He's a leading authority on trader tax status, a Forbes contributor, and author of Greene's annual Trader Tax Guide. Mr. Greene frequently appears in Wall Street Journal, Barron's, other financial media outlets, including MoneyShows.com. He his present tax webinars. He has 4 interactive brokers and other leading brokers. And you can find that at greentradertax.com. Robert, thank you so much for being here. It's all yours.
Thank you, Mark. Today we're talking about how commodity exchange traded funds, ETFs, and options on those ETFs are really taxed. There's some misunderstood aspects to it. We have 30 minutes today. This information is educational. Where you need advice, you should get a qualified tax advisor. We're not affiliated with Money Show. This is not tax advice, this Circular 230 notice. So here's a description of what we're going to discuss today. Commodity ETFs such as USO, UNG, and DBC create unique tax issues because they are often structured as publicly traded partnerships rather than traditional securities registered investment companies, RICs. So your normal stock ETF is pretty clear. It's a security. But when you get into the world of commodities, you're talking about publicly traded partnerships. When you talk about gold and GLD, it's publicly traded trusts. Because they got off the bandwagon of securities, they're a little bit different. What boxes do they fit into? That's a little confusing. And there's other aspects to commodities as ETFs as well to discuss. So as a result, investors may receive Schedule K1s. That's what you get when you're in a partnership. And you're going to report Section 1256 gains or losses. That's on your regulated futures contracts with the lower 60/40 rates. You're going to get a K1 saying, hey, you should be picking up $10,000 of Section 1256 gains on your tax return. It's going to be passed through from the partnership. And you could encounter tax difficulties on different tax rules when you sell. So in this session, we're going to explain the tax treatment on commodity ETF PDPs, including K1s, 1256 pass-through treatment, partnership interest sales, WAR sales, Section 475 mark-to-market accounting, and practical reporting issues such as 8949 basis adjustments. We're also going to discuss tax treatment on listed options on commodity ETF PDPs. So those basis adjustments are really important. You're told to pick up $10,000 of income, you pay it on your tax return, but then when you sell the product, what happened to that 10,000? It's not in your basis. You got to add it manually to your basis, otherwise you double count the income. So here's our current guidance from Green Trader Tax. And I say current because this area of the tax code is evolving. And we're going to talk about that a little later on in the session towards the end. So this is the current situation for 2025 tax returns that people are still working on that are due October 15th. So commodity and futures ETFs are structured as publicly traded partnerships. They're widely held. They're not securities RICs, like security ETFs. You're going to get a K1. You're also going to get a 1099-B for your sales and your cost basis. But the K1s are pass-through items that you have to pick up. If you've never been in a partnership before, it's something new to you. In an S corp or a partnership, you get a Schedule K1 telling you what income to pick up. If there's any expenses listed on it, they're not deductible unless you have trader tax status. So you're going to get a pass-through of Section 1256, where 60% is the long-term capital gain, 40% is the short-term capital gain, and other items to investors. So you need to increase your tax basis for previously taxed K1 income to avoid double taxation. So if you're hyperactively trading it, you might get a lot of K1s and you're not getting a lot of pass-through items. If you've held it for a while, you could have a few years of pass-through income because it's an ETF. It's not like a future that expires. You're holding an ETF, you could hold it for many years. So the broker doesn't do that. They don't get your K1. They don't know what your pass-through income is. They don't make that adjustment on the 1099-B. If you're using trade log software, they don't do it either. So you need to manually do it in your trade log software or any other software that you use. So if nothing else today, that's an important point that makes it a little trickier for you. The K1 pass-through income or a loss and the basis adjustment. So if they were to pass through losses, you would reduce your basis. You would increase your basis. No, excuse me, you would decrease your basis. So selling the ETF is generally the sale of a publicly traded partnership interest, like selling a security. You're producing capital gain or loss with the realization method. So you buy it in November, you sell it in January. You had deferral through year end because you didn't sell it. You don't recognize it for tax purposes until you realize the gain or loss. and it's a capital gain or loss. So that it's either short-term held under 12 months or long-term held over 12 months with the lower long-term capital gains rates. So holding a long-term capital gain in a commodity ETF, that's better than 60/40 because it's 100% long-term rates. But if you're hyperactively trading it, you're better off with 60/40 rates than short-term capital gains rates, which are ordinary rates. So the commodity ETF PDP interests are generally treated as securities for Section 1091 WAR sale compliance rules and may qualify for 475 mark to market for traders with a 475 election. So on the WAR sales, one of the biggest scourges for traders, if within 30 days before or after you make a trade, a losing trade, you buy back a replacement position, the loss is deferred. Now, WAR sale losses apply to stock securities and options on stocks or securities. They don't mention partnership interests, but we pretty much apply WAR sales to partnership interests like the PDP because it's widely held. Now, for the same reason, when it comes to 475 mark to market accounting, traders with trader tax status, trading every day, all day, 4 trades a day, 4 days a week, 60 trades a month, 720 a year, that have trader tax status, they want to elect mark to market accounting for ordinary gain or loss treatment. And if with mark to market accounting, it applies to securities, but Section 475C2 subsection includes partnership interests, trust interests like the GLD. So if you're a TTS trader trading PTPs, you're going to have that included in the ordinary gain or loss treatment, which is great if you have a big loss. You don't get a capital loss limitation. You don't get a WAR sale loss limitation. And if you have gains with Section 475, you can get the 20% qualified business income deduction. So make 100, write off 20,000. So when you sell the commodities futures ETF, that's not the sale of a futures contract subject to 1256, 60/40 tax rates. The investor gets the benefit of 60/40 inside the ETF itself. So when you sell it, you don't report it as 60/40. You got the 60/40 treatment on the K1 pass-through from inside the ETF. Some tax advisors treat the listed options on commodity futures ETFs as non-equity options. So you have a listed on a qualified board of exchange, you have a listed option on a commodities ETF PDP. A lot of tax advisors, and historically we have done this, are saying that it's a non-equity option, a catch-all on Section 1256. Equity options are not 1256, but non-equity options can be 1256. So some treat it as 1256, the option. Others treat it as equity options outside of 1256. Broker treatment varies on 1099. Some brokers give you 60/40 on the gains from the options, because the options you're not getting K1 pass-through. So if you want 60/40 on the options, you got to take the position that you can do so. Some accountants allow that, some don't. We have new wrapper series of content. We're shedding more light on that on an evolved case we'll talk about momentarily. Section 475, traders eligible for trader tax status can elect Section 475 mark-to-market accounting. Section 475 includes partnership interests, including commodity ETF, PTP. Section 475 is ordinary gain or loss, exempt from WAR sale losses, exempt from the capital loss limitation. So if you're going to treat the options on the PTP, the commodity ETF PTPs, as equity options, then they're going to be subject to Section 475. So if you lost $100,000 trading commodity ETF PDP and the options on them as equity options on them, you had, let's say, 80 loss on the commodity ETF and 20 loss on the options. You're going to write off that whole 100,000 against your wage income and get a nice big refund or owe a lot less tax. But if you carve out the options on the ETFs as 60/40, as 1256, as non-equity options, Then they're exempt from 475 as Section 1256. And you would get the 80,000 write-off on the losses of the PTP, but you would have a commodity 1256 loss on the options, which is limited to 3,000 in the current year. But there is a 1256 loss carryback election that you can do. So the historical framework, which includes this year, says that some practitioners, including Green Trader Tax, argued that listed options on publicly traded partnerships and publicly traded trusts could qualify as non-equity options in Section 1256 because a partnership or trust interest is not literally a corporate stock or a single ETF or a trust interest, and a trust interest is not obviously a narrow-based security index. So to get if it's an equity option, you're not getting 1256. If it's a non-equity option, then you can. But historically, the interpretation helps support prior 1256 treatment on those listed options. Now, there's emerging reassessment pending wrapper framework. Historically, green trader tax position for green trade for us was listed option on certain commodity ETF, PDP, and publicly traded trusts were often analyzed as potential 1256 non-equity options because the underlying partnership or trust interest is not literally corporate stock. It's not itself a narrow-based index. Apple stock is a security. Options on Apple stock are a security because it's an option on a stock, a security, and that's why it's an equity option. A PTP is not on the list of what's included in Section 1091 wash sales. It's not a security, it's not an equity, it's not an option on that, and you can get 1256. The current reassessment or pending wrapper series is reviewing whether greater emphasis should be placed on the exchange traded wrapper itself. So we're looking at the wrapper itself that contains the interest, saying that's acting more like a security. It's trading on a securities exchange. The broker's treating it like a security. So maybe we should treat it as an equity option that's not 1256 rather than a non-equity option. And if it is an equity option and you have 475, it's going to be included in the 475 because it's a partnership interest included or equity option on the partnership interest. Practical caution, investors own exchange-traded partnerships or trust interests. Listed options are written on those exchange-traded interests rather than directly on the underlying traded contracts. So these are not options on an underlying contract of regulated futures contracts. It's an option on the wrapper itself that contains those interests. So you're not trading futures, you're trading an ETF that contains futures. It's a matter of semantics, but it has a lot of importance in the evolving position. So prospective caution, taxpayers should not automatically assume 1256 treatment anymore for listed options on commodity ETF PTPs without reviewing product-specific facts, broker treatment, exchange classification, and professional guidance. So we need this situation to evolve a little bit more. There's a little confusion, I would say, out there in the marketplace with accountants doing varying treatment. Some are treating it as non-equity options, some as equity options with profound consequences. So our updated wrapper series should come out in October in time for the 2006 tax filing season. Let's see how we're doing on time. So we're doing pretty good on time. So you can come over to Green Trader Tax to find out more information. You could email us. You can get a consultation with Green Newswander and Manning. Here's our website. Let me go over to it. Now, here's our wrapper series. This article is pending an update for the next tax year. 2024. 2025. 2026. 2027. 2028. 2029. 2030. 2031. 2032. 2033. 2034. 2035. 2036. 2037. 2038. 2039. 2040. 2041. 2042. 2043. 2044. 2045. 2046. 2047. 2048. 2049. 2050. 2051. 2052. 2053. 2054. 2055. 2056. 2057. 2058. 2059. 2060. 2061. 2062. 2063. 2064. 2065. 2066. 2067. 2068. 2069. 2070. 2071. 2072. 2073. 2074. 2075. 2076. 2077. 2078. 2079. 2080. 2081. 2082. 2083. 2084. 2085. 2086. 2087. 2088. 2089. 2090. 2091. 2092. 2093. 2094. 2095. 2096. 2097. 2098. 2099. 2000. 2001. 2002. 2003. 2004. 2005. 2006. 2007. 2008. 2009. 2010. 2011. 2012. 2013. 2014. 2015. 2016. 2017. So green trader tax's current framework generally begins with a legal exchange traded instrument or wrapper that the trader owns rather than automatically looking through to the underlying commodity exposure. Let's look at the summary. The issue of the K1, you offer in the pass-through. It just remains internal futures contracts. I think we went through all this. I guess you can read the contract, the blog post when it comes out. Now, Mark, maybe you can see how many people in the room think they're traders with trader tax status, or this is more investors that accredited investors looking for investments rather than trading. And do you have any questions you want to ask me?
Um, yeah, a question came in here. Can a trader revoke mark to market once elected?
Yes. So if you stop trading, you need to suspend use of mark-to-market accounting immediately. So if you stopped at the end of, let's say, June 30th, you would stop using TTS and 475 as of June 30th and revert to capital gains and losses in July. And it would be so-called suspended because you can only use 475 with a valid TTS election. And then in the following April 15th, you could formally revoke it with a reverse, with a mirror election to when you elected 475. So the same way you elected it with an election statement by April 15th, and then a follow-up perfection of it with the Form 3115, you're going to revoke it in the same process as the election, and then you can't re-elect it for 5 years. Any other questions?
Yeah, here's another question, and this is kind of right up our alley. They're asking, can traders deduct education, coaching, and trading conferences?
Well, you need trader tax status for that. So I just updated all this with some new blog posts here about trader. So if you have trader tax status, you can have TTS business expense treatment. So trader education. So let's say that you took a class January 1st to June 30th, and then you started trading in July. January to June was pre-trader tax status, but you can capitalize it as a Section 195 startup cost going 6 months back from before you qualify, and you qualify in July 1st, 2026. So you would capitalize right off the first 5,000 up front, the rest over 15 years. But if your TTS started January 1st, and then you took the trader education classes while you were already in TTS, then it's a full business deduction without capitalizing Section 195 and without amortization. Any other questions? We
All
got
right,
some good time left here. So if
yeah,
people have questions, get them on the board here.
yeah, no problem. Another question here is, can a trader qualify if they also for TTS if they also have a full-time job?
Yes, they can. So you want to go over to TTS, how to qualify, and it mentions that in one of the hours period. So all the benchmarks, you want to hit all the benchmarks. It doesn't have to be your primary living. You need to make your intention to make a living. So you can be a part-time trader and even a money-losing trader and still qualify and get the ordinary loss treatment with the Section 475 and not have to get stuck with a huge capital loss carryover. You just better, the IRS is going to be a little bit more stringent with you, or scrutinize you more. So just make sure you hit all the benchmarks and read these two blog posts. I did these over the past week. I updated this page on how to qualify, and also for how to qualify for trader tax status is the new vibe. I vibe coded this app, and you can do this app to see if you qualify or not. And then if you do qualify, you can go over to the business expense page, just fill in the tax center and see all the different write-offs. And there's a whole chapter on the write-offs in Green's 2026 Trader Tax Guide.
All right, thank you. Another question here came in regarding crypto trading. They're asking is how is it taxed compared to stock trading?
All right, so you want to go over to the tax center and go over to the tax treatment of financial products, go over to the exchange traded products, go over to cryptocurrencies, and it is a lot of blog posts are about the cryptocurrency stuff, and it's big in the guide. We covered that from the beginning. Like stock, it's realization. So if you're a holder, you don't pay tax, capital gains tax until you sell it, use it, or have any transaction with it where it's treated as a sale. Then it looks to your basis that's just short-term or long-term capital gain or loss. Good news, it's not a stock or a security or an option on that, so it's exempt from war sale loss rules. It's also not covered in Section 475. So it's strictly realized gain or loss. 12 months is short-term, longer is long-term, lower rates, and no war sales. But you trigger that in you report it on cryptocurrency to fiat, crypto to alt, purchases of goods and services. So all those transactions are a sale. And if you even touch the cryptocurrency, you got to acknowledge that on your tax return. So there's a lot of writing we did about it over the years, and you want to stay in touch with that and read our blog posts about that. So you want to come over to the blog posts over there and look at the cryptocurrency posts. And there's a whole new section of blog posts on what's the taxable events for digital assets, selling fiat currency, exchanging property, goods, services, swapping one for another, receiving digital assets as payment, acquiring new assets, hard forks, Bitcoin Cash, airdrops, earning through mining, staking via airdrop, all the disposal, determining basis, amount realized, digital asset codes. That's just it. Look at this one blog post. And then there's all these other related blog posts. So there's a ton of blog posts on the crypto. And we should do maybe crypto in one of the future money show stuff. So next question, Mark. I'm glad we have time for those today.
Yeah, absolutely. Thanks so much for taking these questions. Another jumping over to S corps. They're asking what income level does an S corp become attractive?
Well, you want to go over to the entity planning, entity solutions. So first of all, S corps cost money. It costs money to set up, to maintain, some minimum taxes, the working with our firm for tax preparation. So you only want to do it if you can really count on getting huge benefits that are much higher than the cost. So if you lose money, there's no benefits really to you. The biggest deductions are the retirement plan and the health insurance. You could have trader tax status on a Schedule C as a sole proprietor. But if you want the retirement deduction, the health insurance deduction, that could be 80,000 for the retirement, 20 for the health. It could be $100,000 of write-offs. And plus a SALT cap workaround. Let's say you pay 50,000 a SALT above what you get with itemized deductions. You use the standard deduction. You're in California, you get that other 50. So you had 100 from retirement um, and payroll tax deductions, the health insurance, and the SALT cap. So you're up to, let's say, 150. You're going to save 60,000. So if it costs you 3,000 to have a S corp, no big deal. It's a slam dunk. It's a good thing to do. So, but you got to have a history of profits and really want to maximize a retirement plan. And maybe you don't need a health insurance deduction because your spouse has it or you have it in a job. So if you come to Green, Responder, and Manning because you want an S corp, they're going to probably talk you out of it unless you really need one. The last thing we want to hear from is a client at year end saying, "Why did I incur this cost and aggravation and extra work without a slam dunk of tax savings?" Next one, Mark.
All right, thank you so much. Another question came in here. Can traders combine Section 1256 gains and MTM accounting?
Yeah, you can have Section 475 for all your trading in securities and in commodities too, but you can get the 60/40 on the options, the non-equity options on the listed PTP options and the GLD. But most of the people are holding 1256. So you're electing your TTS in securities, you're electing 475 on securities only. You could elect it on commodities, but you would rather retain the lower 60/40 tax rates, which could be 12% less. In the highest tax bracket, instead of paying 37%, you're paying 26.8%, 26.2%, excuse me. So you want to keep the 60/40 so you can separate it and keep it and get the best of both worlds. And for more about 1256, go back to the tax treatment, go to the 1256 contracts, and look at the table here about all the differences. A 10.2% savings in the highest tax bracket, 12% in the next to the highest tax bracket. So the next question, Mark.
All right, thank you so much. Um, Question here. They're wondering, as far as deductible trading expenses, in your years of experience, what deductions are commonly overlooked the most, in your opinion?
Okay, so let's come back to the business expenses. Home office could end up being one of the biggest expenses, and it doesn't cost you any money. You're spending the money on your home anyway. And some people back off because they don't have exclusive use or they think it might draw attention, a red flag. It's no longer a red flag. It doesn't have to be your main principal office. You can't take the loss, the home office expense, unless you have income to offset it. So a lot of people back off that deduction, and it actually makes your trader tax status look better. The education is a big one. Some people don't realize they can capitalize a startup. Borrow fees for short sellers. A lot of people miss out on that. So market data, quote services, all that, platform software subscriptions. So let's say you have automatic trading system software. If you write the code yourself, vibe code it, you're involved with the entry exit signals, you can get the trader tax status for it and deduct those automatic trading symbol system deductions. But if you're getting algorithms with API scripting and you don't do anything except buy some canned program out there, you're not getting TTS for that and you can't deduct those expenses. So computers, furniture, all your expenses and equipment, monitors, peripherals, office equipment, you're getting bonus depreciation 100% with the OBA tax bill, which permanently extended the Tax Cuts and Jobs Act, TCJA. So you're getting first year write-offs on all your expenses. Just get them on the books before year end, and you got to place them into service before year end. Your research and expenses under Section 174, research and development costs, a lot of it can all be capitalized and written off. A lot of people don't realize that and overlook that. Your professional fees, accountants, lawyers, all that stuff. The tax prep fees are not deductible for employees or investors, but they are for traders for the trading portion of your tax return. Books, publications, supplies, travel. Don't write off the car. You're not using the car for trading. One guy once told me, I'm going to the mall and trading GameStop and some of the mall companies, and I'm doing my research that way. You're still not using the car every day for that. So you're not a flower shop with a flower truck that you're making deliveries. So those are some of the main expenses that people have. You may want to get the guide and get the whole thing there, the whole list of expenses and how they work. What's next, Mark? What else do you have? These are good questions.
All right, I have a couple minutes left here. Jumping over to options, they're wondering how are index options taxed differently from equity options?
Index options are broad-based indexes composed of 10 or more underlying securities. So SPY is an ETF, it's 1256. SPX is a broad-based stock index, is a stock index future, it's 1256. So if you come over to the blog post and go to tax treatment of financial products, go to 1256, there's a list there, and here are the U.S. broad-based index is made up of 12 or more underlying, also known as, so SPX is 1256, SPY is securities, options on SPY are securities, options on SPX are 1256.
All right, thank you so much, Robert. We have just a couple of seconds left. Any closing remarks from you?
Well, come over to the website. You can see it's very useful. It's got answers to a lot of questions. Green, Neuschwander, and Manning, those are the ones that prepare all the tax returns for the traders. I founded the firm. I'm no longer managing it. It's Darren Neuschwander and Adam Manning. They're doing all the consulting with Star Johnson to see if you have TTS, see how you're handling crypto, see how you're handling tax treatment, covering some of the issues we did today and more. That's a consultation. That's what the three of them are doing that all day long. There's a lot of other CPAs doing the accounting services with TradeLog or doing the tax returns, defending you if you have any state issues. And otherwise, I focus my time on the content now, hosting still webinars and doing the blog posts. So we hope to hear from you. You can read about the firm, been in business since 1983. Got strong media recommendations. A lot of great professionals here have been with us a long time. And there's others who are not shown here, but who are still with the firm, but they're new. They don't get on the board until another year goes by. So thank you, Mark. Thanks to Money Show.
Yep. Thank you so much, Robert. Always a pleasure. Everyone check out greentradertax.com. Thank you for taking the time to join us today. And Robert, thank you again. We greatly appreciate it.
Thanks.
All right, everyone, thank you so much for joining us for Money Show's virtual event kicking off this morning. Stick around, we have more great content coming your way over the next 2 days, so be sure to check all that out. And we were speaking here with Robert Greene, CPA, CEO of GreenTraderTax.com. Stick around, we'll be back momentarily.